Welcome to the latest Reuters Newsmaker event. I'm William Schomburg. I'm the Chief UK Economics Correspondent for Reuters in the UK, based in London. And today it's my great pleasure to welcome Andrew Hauser from the Bank of England, where he is Executive Director for Markets. Andrew has been at the bank for nearly 30 years, and in his current job, he manages the bank's nearly £900 billion balance sheet, which has been newly enlarged since the pandemic crisis, of course, as well as Britain's foreign reserves, and he provides market intelligence to the monetary policy and the financial policy committees. Andrew was at the centre of the storm when markets went into chaos last March, just as Mark Carney was leaving the Bank of England and Andrew Bailey was arriving. And in today's speech, Andrew will share his thoughts on the lessons of the dash for cash that we saw almost a year ago. Then I plan to ask Andrew a few questions before opening things up to the audience. So with no further ado, over to you, Andrew.
Well, thanks, Will, and thanks everyone for watching today. Sorry we can't be with each other in person, but it's great to be able to talk to you about these topics. Let me first give my remarks, and then I'll look forward to discussing some questions with you, Bill, and the audience. Increasingly, we look to financial markets, not banks, to care for our savings or provide credit. Millions save via pension, investment, or exchange-traded instruments. Companies and local authorities hold cash in money market funds, and firms large and small borrow from capital markets or non-bank lenders. Taken together, fully half of all financial assets are now held outside the banking system. Those aren't new trends, and to the extent they bring broader access to cheaper, faster, and more diverse financial services, they're good news, but they do pose novel challenges to financial stability. In particular, as usage grows, market-based finance seems increasingly prone to liquidity shocks. Some of that reflects vulnerabilities in business models and practices of specific market participants, liquidity mismatch in funds, leverage and trend-following investment strategies, insufficiently forward-looking margining practices, but it also reflects a growing imbalance between the size of key markets and the balance sheet capacity of banks and dealers who traditionally help transfer risk smoothly between investors and borrowers, and that's shown here on the screen. The nature of those vulnerabilities and the need to consider stronger measures to safeguard financial stability have been extensively discussed in recent years, but last year's COVID dash for cash was a wake-up call as to the scale and urgency of that work. It's unsurprising that the initial wave of lockdowns last spring caused a surge in demand for precautionary liquidity, but the implications of that shift were greatly amplified by a breakdown in the functioning of markets, core to the maintenance of monetary and financial stability. And many of those long-standing vulnerabilities I mentioned a moment ago were in play. Liquidity imbalances between asset maturities and redemptions in money market and other open-ended funds exacerbated moves in asset prices. Gaps in liquidity planning meant some firms had to scramble to meet margin calls, and sharp disruptions in government and corporate bond markets raised questions about the role of leveraged investors and the willingness and capacity of dealers to intermediate at times of stress. To avoid an even deeper economic collapse, the functioning of those markets had to be restored rapidly, and that was achieved through swift and decisive central bank action, using large-scale asset purchases and other tools capable of tackling both the economic shock and that market dysfunction. And since March of last year, G10 central bank balance sheets have risen by over $8 trillion. That was an appropriate response to a truly unprecedented situation, just as powerful anti-inflammatory medicines are the right solution to a sudden and massive flare-up. But such drugs are less well suited to treating long-term conditions. And there's every reason to believe that absent further action, we will see more frequent periods of dysfunction in the very markets increasingly relied upon by households and firms if business model vulnerabilities persist and intermediation capacity remains strained. The public authorities like the Bank of England can't afford to ignore such dysfunction if it reaches a scale that threatens financial stability, but equally we can't rely on central bank medicine at the scale and duration seen last year every time there's some kind of inflammation. The costs in terms of bloated public sector balance sheets and mispriced private sector risk will be too high, and the policy actions needed to secure monetary and financial stability might not always be as well aligned as they were during the crisis. If our financial markets are to support the increasing reliance placed on them safely, we must therefore do more to reduce the scale of inherent vulnerabilities ahead of time and build better targeted tools for dealing with financial instability caused by market dysfunction ex post. And that in turn requires work in three separate but self-reinforcing areas shown here. The first step at the top, ensuring that non-banks active in financial markets are more resilient to future liquidity shocks, is underway, coordinated by the G20's Financial Stability Board. If successful, that should both reduce the likelihood of instability arising in the first place and improve the private sector's ability to deal with it if it does occur. Step 2, on the bottom left, relates to the potential for market participants acting on their own or together with the authorities to reduce vulnerabilities by strengthening market-wide infrastructure or practices. And the recent proposal by Darrell Duffy to mandate central clearing of US government bonds is an example of that kind of work. But my topic today relates to step 3 on the bottom right, the role that central bank balance sheets should play in dealing with market dysfunction. I deliberately come to that last because while it's central bank's job to restore financial stability where self-insurance is too costly, they should be backstop providers of liquidity and not a first port of call. In that sense, their tools should complement, not substitute for, the other vertices on that triangle. And outside of pandemics, massive doses of system-wide anti-inflammatories don't really meet that design brief. Long-term protection requires a more targeted remedy, as the Bank's Financial Policy Committee concluded last October. So in the remainder of my remarks today, I want to look first at the evolving role of central banks as liquidity providers, second at the lessons for the Dash for Cash episode, and third at some possible design features and challenges for a new generation of central bank tools aimed at market dysfunction. That word new should perhaps be in inverted commas because in many cases we're building on the substantial foundations provided by past thinking, perhaps given new urgency by what we experienced last year. Now, according to Ralph Hawtrey, one of the doyen of early 20th century economics, the defining feature of central banking lies in taming what he called the inherent instability of credit. And the canonical description of how to achieve that is given by Walter Bagehot's description of the so-called lender of last resort, or LOLR, which in essence recommends stemming financial panic by lending freely to sound institutions against good collateral and at rates materially higher than those prevailing in normal conditions. For much of their lifespan, central banks have provided such LOLR primarily to commercial banks. Banks specialize in lending to households and firms, but are inherently vulnerable to liquidity risks given the maturity mismatch between their long-term assets and their short-term liabilities. Over time and the experience of successive banking crises, LOLR has been supplemented by an extensive prudential regulatory regime for banks, requiring them to take greater ownership of managing their own risk and setting quantitative minima for liquidity buffers. In short, a banking version of that triangle I showed a moment ago. But while LOLR may have been primarily focused on banks, there are also historical precedents for central banks stepping in to restore broader market functioning at critical moments. In July 1914, for example, the Bank of England made large-scale purchases of bills of exchange after the uncertainty caused by the onset of World War I brought the market to a halt, threatening widespread contagion. The Federal Reserve took similar actions in the US Treasury bond market in 1939 at the start of World War II, 1958 following a regime change in government funding arrangements, and 1970 amidst unrest over the Vietnam War. And by degrees, those and other actions more recently show a gradual broadening in focus by central banks from backstopping just the funding liquidity of banks to backstopping market liquidity too, when severe dysfunction threatens financial stability. But it wasn't until 2007, in the foothills of the global financial crisis, that Willem Boyter and Anne Siebert coined the phrase now widely used for this activity, or market maker of last resort, or MMLR. Boyter and Siebert believe that central banks should be ready to tackle dysfunction in securities markets relevant to monetary or financial stability by making two-way prices to buy and sell those securities or lend against them. Risk would temporarily be transferred off dealers' balance sheets, freeing up capacity to return market liquidity to more normal levels. In all other respects, they recommended following Bagehot's principles. That means, standing ready to operate at big size if necessary, but only at prices, rates, and collateral haircuts that would protect public money and avoid moral hazard. Such terms, they believed, would also ensure that the central bank's financial exposures, naturally unwound as market conditions normalised, would purchase assets being sold back to the market or repo exposures maturing. Many historical central bank operations in securities markets, including some of those undertaken in 08-09, involved just one-way purchases, so didn't have that self-liquidating feature that I described. One exception was the Bank of England's corporate bond secondary market scheme, introduced in 2009, and from 2010 offering daily two-way prices on a wide range of high-quality sterling corporate bonds issued by non-financial corporates to aid secondary market liquidity. These prices were determined at a spread around the market price, so moved up and down with the market, and set at levels that incentivized market participants to sell to the bank when market functioning was poor and buy when market functioning returned to normal. The implications for the public sector balance sheet were pretty modest. Even at its peak, as this chart shows, the scheme only owned about 1% of eligible bonds, but the existence of that two-way backstop pricing helped liquidity return to the market and delivered a natural unwind in the facility, with bonds being sold back to market participants as functioning normalised. The review of the bank's liquidity framework carried out by Bill Winters in 2012 recommended formalising the bank's approach to MMLR, setting out public principles under which future interventions might occur, and various proposals on what those criteria might be have been made in the wake of the financial crisis by, amongst others, Paul Tucker, Perry Mehrling, Michael Dooley, Stephen Cicchetti. But in the event, the bank, in common with other central banks, chose to say relatively little in public, and that reflected a number of reasons, including the practical challenges of working out which markets you might want to operate in, the terms on which we might do so, and the consequences for public money. And in the years that followed that work, the topic received very little active attention, either inside or outside central banks. The experience of COVID has changed that. This isn't the place to review the actions taken by central banks since last spring in any detail. Many others have covered that elsewhere. But I want to pull, as Bill said, a couple of lessons from that experience that directly or indirectly can help inform future tool design. The first lesson highlights limitations in our existing liquidity provision toolkit, which is focused primarily, as I said, on lending to banks. The Bank of England did provide extra liquidity to banks through a wide range of different facilities at favourable rates in the early stages of the March crisis, and other major central banks took similar steps. Using those facilities, banks did play a part in channeling liquidity to the wider market, materially increasing both their borrowing from us and their on-lending to their own counterparties. But they just didn't exhaust the extra central bank liquidity on offer at all, and their on-lending was insufficient to meet the explosion in liquidity demand from non-banks, driving term repo rates and government bond yields sharply higher. With the normal central bank antibiotics struggling to reach the source of the infection, it was time for stronger medicine. The huge asset purchase programs unleashed in spring 2020 had a dramatic and immediate calming effect, getting in all the cracks of the liquidity shortage amongst non-banks and taking duration off dealers' balance sheets. Central banks made it clear their operations were aimed in part, and at least initially, at restoring market functioning. And the Bank of England said it would complete its asset purchases as soon as it was operationally possible, consistent with improved market functioning. The Federal Reserve said it would purchase Treasury securities and agency mortgage-backed securities in the amount needed to support smooth market functioning. And the ECB framed its decisions in the context of severe strains in the financial markets, posing risks to the ECB's monetary policy transmission becoming significantly impaired. Asset purchases have accounted for all of the net increase in the Bank of England and Federal Reserve balance sheets since last spring, shown in red here on the left and right, and about half of the ECB shown in the middle. And many other central banks in other jurisdictions took similar action. Despite their success in the unparalleled circumstances of COVID, those actions provide, I think, only limited guidance as to how we might best respond to future instances of market dysfunction, driven by the more structural trends that I outlined at the start of my talk. They were one-way purchase operations of relatively long duration assets, so they had they were not programmed in advance to unwind or self-liquidate when core market functioning returned, as it did by the late spring of 2020. Central banks therefore were buyers of last resort rather than market makers of last resort. Purchases typically took place at prevailing market prices. In other words, the Bagehot principle wasn't really applied. While not charging an insurance premium to market participants for an extended period may be understandable in a severe and unexpected pandemic, it's harder to justify doing the same and providing market participants with an expectation of similarly priced public support if market dysfunction occurs in the future because of well-understood vulnerabilities. A key part of the success of the COVID asset purchase programs was that they took large quantities of risk off private sector balance sheets, meeting the heightened demand by non-banks for cash and allowing intermediaries to return to providing finance to the real economy. At the same time, of course, that means more risk on public sector balance sheets. Whatever it takes may apply in a global pandemic, but public authorities will be more sensitive to the costs of the public purse if future episodes of market dysfunction emerge because of vulnerabilities inherent in the financial system. The COVID response was unanticipated and discretionary. And while that again was fully justified in this instance by the unprecedented nature of the shock, the use of sort of ad hoc tools risks embedding inappropriate expectations amongst market participants about how market central banks might behave in future cases. Finally, and perhaps most profoundly, the fact that the economic shock and the market dysfunction were both caused by the same event, exogenous event, meant that a single tool, large-scale discretionary purchase of duration assets at market prices, could effectively restore both monetary and financial stability in a single hit. But in different circumstances, the optimal policy response for the two goals could easily diverge. Drawing together the unfinished business of that thinking I described earlier, the COVID experience, and the expectation of continued reliance on financial markets by households and companies, let me identify a couple of tentative conclusions for the future design of central bank tools. The first is that central banks are likely to face increasing calls to provide public liquidity insurance for instances of severe financial market dysfunction in the years ahead, as reliance on those markets grows, vulnerabilities to liquidity shocks persist, and intermediation capacity remains constrained. Clarity will be needed as to whether, and if so how, such activities fall within central banks' formal remits. And in some cases, they may be able to use existing tools designed for monetary policy purposes, as we did last year. But in others, those tools, I think, are pretty likely to prove rather poorly suited to the task, and new ways will be needed to achieve those ends, whether through outright purchase and sale operations, repo facilities, or other means. Second, central banks will need to decide which marketable assets should be in scope of any new tools. The most obvious candidate is government bonds, which lay at the epicenter of the dash for cash last year. But for other riskier assets to qualify, a case would need to be made that sufficiently core to monetary and financial stability, and that central banks can price and risk manage them effectively. It is notable, though, that many central banks bought a range of assets beyond government bonds in 08-09 and the COVID crisis, including corporate bonds and commercial paper. Third, central banks will have to reflect on whether the use of their balance sheets to address market dysfunction should be primarily discretionary, or whether at least aspects of that role should be formalized into standing facilities, the terms of which are known in advance. The case in favor of standing facilities is that a known reaction function allows market participants to organize their business, price risks in advance of episodes of expected dysfunction, avoiding on the one hand over-optimism about the circumstances in which public support won't actually be forthcoming, which incentivizes them to take care of their own self-insurance, but also avoiding over-pessimism about when it would be available, allowing safe business to thrive. It may also provide confidence that the system is backstop against operational or other idiosyncratic market-wide events such as systemic IT outages. Fourth, careful consideration will need to be given to who should have access to these tools, either directly or indirectly. Restricting access to banks alone isn't likely to be sufficient to stabilise core markets, given the increasing importance of the sorts of non-bank participants I discussed earlier. But access criteria would still be needed to limit the financial risks to which public money is exposed, to ensure public insurance isn't provided to firms who have not first taken steps to provide for their own resilience or that of the wider system, and to ensure that the sheer operational feasibility of any new tool is acceptable. The quid pro quo between central bank access and meeting robust prudential standards is one of the key reasons why these discussions need to happen in parallel with those taking place at the G20's Financial Stability Board. Fifth, and finally, the terms and conditions of such facilities will also need to be carefully calibrated to ensure those same risks are effectively managed. In particular, that means ensuring that prices, rates, and collateral haircuts are well aligned to those Bagehot principles to ensure that any facilities remain strictly backstops used only when conditions become materially dysfunctional, but leave the burden of ensuring safe operation during a wide range of more normal market conditions with market participants and the regulatory regimes they're subject to. And second, ensuring facilities are naturally self-liquidating in that they build up exposures when markets are dysfunctional, but run them down when functioning returns to normal, delivering sufficient risk transfer to kickstart private activity during periods of dysfunction, but limiting the scale and persistence of risks to public funds. These aren't straightforward trade-offs, and different jurisdictions and countries could choose different points along them, depending on a whole range of reasons, including the relative importance of banks and financial markets and their local economies, their central bank mandates, and their risk preferences. But given the multiple institutional, technological, and cross-border linkages that characterize our core markets, we have a strong common interest in setting out the choices. A recent Brookings paper by Nellie Liang and Pat Parkinson touches on a number of these issues as they relate to the US Treasury market. Let me conclude. It's sometimes said that hard cases make bad law. We should certainly be wary of drawing overly direct conclusions from the COVID pandemic, given how truly unique the circumstances have been. But many of the vulnerabilities in financial markets exposed last spring have been staring us in the face for some time, in many cases for many years, and will only grow in importance in the years ahead as households and firms come to rely ever more closely on such markets to care for their savings and fund investment. So we must seize this opportunity for reform. The primary focus lies in strengthening the resilience of those active in financial markets through the vital work underway at the FSB. Prevention is much better than cure. The central bank tools have a role to play too, and I've discussed here today some of the design features a new generation of such tools should have. I look forward to the debate to come. Thank you.
Thank you very much, Andrew. That was that's a very interesting speech. I'm going to take advantage of being in control of the operation here to ask some of my own questions, and then other people are bringing questions from other people, including perhaps some of my colleagues at Reuters later. You said that the vulnerabilities from the non-bank sector were staring us in the face for a while, but how surprised were you, and how surprised was the bank by the scale of the problem that emerged during the dash for cash? Can you talk us through a little bit about how those problems became apparent, and what was it that really caught you by surprise?
Yeah, I mean, I think, look, I mean, there's no point denying everybody was surprised by the scale of what happened last year. I mean, obviously, the big surprise has been the onset of the virus itself and the public policy measures that have been necessary in response to that. And in some sense, you know, what we're talking about here is a second or third order knock-on from that. And I've no particular expertise in the medical and public policy side of lockdowns and all the rest of it. That's for others to judge. I mean, clearly what happened at that point, and particularly in the context of the first lockdown, was that everyone said, I need cash. I have no idea, you know, whether my income is going to fall to zero, and I have no idea how I'm going to meet my outgoings. I need just not liquid instruments, I actually need money. And I think one of the surprising things, probably to everyone, was that even those, you know, who maybe not like a household who has a bill going out the door, felt that even the highest quality assets in US treasuries and gilts and the equivalents in other markets, were not sufficiently liquid, or they didn't have sufficient confidence in their liquidity to meet their needs, and so they felt they had to sell them to get cash. Now, that extreme liquidity preference, if you like, and the scale and suddenness of it, I think caught everyone by surprise, and was a function of the scale of uncertainty, perhaps even the word panic at one point that kicked in. I think then the ways in which that initial impulse were amplified across the financial market was also interesting, and we certainly learned quite a bit. I mean, I talked in a speech, as you mentioned, last year about what I call the sort of 7 moments of that process. The first one, actually, that we became aware of was clearly activity amongst the leveraged fund community, who in many cases were sitting on one side of these intermediation flows I talked about in the financial markets, with large funds sitting on the other side, who felt the need to liquidate positions quite rapidly. That was the beginning of it. It certainly wasn't the largest single part of the amplification, but some of our earliest conversations, perhaps because of the nature and the speed of those people's trading functions, became apparent. The role played by money market funds, who for a period suffered very heavy outflows and found it difficult to liquidate the assets that they were holding in sufficient quantities to meet outflows, was probably the next set of shoes to fall, and a series of conversations with large life assurance and pension funds as well. I think, each of those linkages independently, we and others had flagged up as being important for some time. And those of us, I can't remember if you were looking at this at the time, Bill, in the autumn of 2019, saw some of these things occurring in the repo spike in the US repo market when interest rates took a different direction in the US. So there were some elements of that I think we had expected to see. But there's no doubt that the scale and the speed of it took everyone by surprise and was a real wake-up call, I think, in terms of what we're talking about now, really.
Yeah, absolutely. So what is the way forward now? I mean, the process of reforming the banks after the global financial crisis it took quite a while, right? It was several years, a process that stretched out over several years. What do you see as the way forward for these kind of reforms that you're talking about? Obviously, the Financial Stability Board is doing its thing about making market non-bank players more resilient, but you're talking about the central bank tools. Where do we go from here?
Well, it's a good question about timing, because I mean, these risks could recrystallize at any stage. We hope they don't. We've got policies in place to hopefully to ensure they don't, but you never know. The FSB process is designed to take place. The main work of the FSB process is designed to take place this year, with a report going back to the G20 under, I think, the Italians in October. So that timeline is quite accelerated, and there's a huge amount of work, a daunting amount of work, in fact, going on in numerous working groups, which are all international in nature, to try to think about ways in which those mitigants can take place. I think the central banking thinking has to take place on a very similar timescale. It's something that has to happen internationally as well. There isn't much point in a plucky single country, whoever that might be, whether it's us or anyone else, going it alone without speaking and closely aligning what we do with other countries. So I think we are aiming for a substantial progress in 2021. To your point about it taking years, I think it's a fair question how long it will take before all of this is settled. But I can assure you, not least measured by how many hours we're all spending in meetings internationally and nationally on this, that is taking up a lot of people's time. And I think there is real momentum behind it.
Good, interesting. Just you refer about some ideas about the possible future design of the monetary policy, of the tools that central banks could have. So not monetary policy tools, the tools that central banks could use to become a last resort. I mean, could you give us a sense a bit more about the kind of assets that you feel might be covered by those kind of tools, and do you expect sort of that there'll be differentiation in terms of take up and acceptance of non-banks that will agree to sort of do the things that make sure they qualify for that kind of support in future, or those who decide to go it alone?
I mean, you're right. There are many key judgments, but two of the key ones are which assets should these tools apply to, and who should have access to those facilities. Let me take them in reverse order, actually. In terms of access, as I've said, historically we have focused on banks. There are good public policy reasons for that because they are particularly vulnerable to liquidity risk. The key point that I'm trying to make in the speech, and I think we've made many times before, is that liquidity risk is increasingly prevalent in financial markets as well. It's actually a much more complicated beast to get your head around because whereas you can speak to an individual called a bank, and you can hold them to account, and you can speak to the CEO, and you can look at their risk management models, many of these liquidity risk chains are sort of, decentralized. They involve firm A facing off to firm B, facing off to infrastructure C, and you have to trace the chains through. So they are intrinsically much more difficult to map through. But it does seem likely that relying exclusively on banks to act as our kind of go-betweens to these wider markets is going to be insufficient. That's certainly what we found last spring, and I think it's probably what we've expected for a while. The Bank of England, at Bill Winter's encouragement back in the early 2010s, actually decided to expand access to our facilities to broker-dealers and to CCPs. That's been a useful step, but obviously those two entities by themselves don't command the majority of assets in the non-bank sector. So I think we will have to look at the question of how much further it goes. As you say, this will be an issue that different central banks have different views about. And the most important question will be, what is the quid pro quo in terms of the prudential standards that those entities will be expected to meet in return for access? So, obviously the largest single holders of assets in the economy are the investment funds, the life assurance and pension funds, the BlackRocks and asset managers of the world. All of those entities command a very large share of assets in the economy. You then talk about leverage funds, you talk about other entities. There would be, in all probability, a price to pay for access to these facilities. And as you rightly say, those entities would have to judge what price they want to pay in return. But that is part of what the FSB work is designed to look at. In terms of assets itself, I would start with government bonds. And indeed, the paper I referenced, the Nellie Liang paper and Pat Parkinson paper, which is a neat paper and worth people having a look at, recommends a standing facility, that goes back to one of the points I made in my remarks, priced away from the market, another point I made in the mark, for US Treasury bonds, directly focused on allowing a wide range of entities to borrow or lend, actually, in conditions of market dysfunction. And it certainly is a case that when you look at the differential impact of markets last spring, it was really that big rise in yields in government bond markets globally that really set the panic alarms going, I think, everywhere, because people said, well, hang on, now people are selling the assets that we thought was safest of all, and which basically played this core role in all of the prudential standards as setting the price of risk-free money. Suddenly people are even selling those. We better make sure we start with the plumbing in those markets. So I would start there, and some jurisdictions may end there as well. As you say, and as I said, I think there is a good case for thinking about whether similar arrangements might be put in place for some of the higher quality but risky assets. Corporate bonds are assets that obviously many central banks have transacted in during the crisis. It's a tricky area because central banks don't have a lot of expertise in pricing those things. You have to risk manage them if they're on your balance sheet. You have to think about potential adverse selection. So there's a lot of things to work through there. But if you really follow the logic through of this idea that financial markets are increasingly playing this intermediation role that previously banks played, you're probably going to have to at least put your toe in the water of a broader range of markets and a broader range of entities accessing it. I realize I haven't directly answered your question, Bill, so you're probably going to come back to me and say, yeah, all right, that's all very well. Thank you, very long-winded answer, but what's the what are the facts here? I think the reason I'm delivering well, no, I'm not. Well, I'm putting the question myself, so I don't have to answer it. But these are issues which are sensitive issues, to be honest, and they're issues which need to be considered closely alongside the FSB work and colleague central banks as well.
Yeah, understood. So, I mean, are we at this point now because, at least partly because the reforms after the financial crisis had such an impact on banks and the way that they operate, that you created a space for non-banks to rush into at a time when governments were issuing so much debt, which created such an enormous market for them to try and hold up.
Well, let me, if I can, morph that into a slightly different question and then come back. Maybe I think one could reframe the question you've asked as, isn't part of the answer here to go back and look again at the reforms to banks? Tell me off if I've reframed that unfairly, but I think that's a question you hear. My strongest point to that would be, it can't be a good answer to increasing concerns about instability in the non-bank sector to say, well, hang on, maybe we should make banks less safe again. One of the most important aspects of the crisis last year was what didn't happen. And it's always a boring aspect of central banking that you kind of have to point out, a bit like spies or something. Look at all the terrorist attacks that didn't happen. Look at all the banking problems that didn't happen. But last year, there were no material issues in the banking sector during the height of the dash for cash. That didn't happen by accident. It happened because of the reforms since 2008. And we don't want to materially unwind those things and go back to a world of massive unemployment and all the issues that came out of 08, 09. Equally, it isn't realistic to expect for banking balance sheets to keep growing. And that chart one that I showed, indefinitely, with the size of markets, which, as you described, are growing rapidly and will continue to grow rapidly under the pressure of the fiscal expansions that we're seeing. You couldn't expect those balance sheets to just keep growing forever. And so I think two things for me flow from that. One is we have to work out how to use the available capacity more efficiently. That's part of this triangle of reforms, and particularly work like Darrell Duffy has been promoting, which say, look, let's not leave all this stuff stuck on private balance sheets for extended periods. Let's improve the settlement functions. Let's improve the market matching structures so that intermediaries' balance sheets can play the role they need to in matching buyers and sellers, but then you offlay that risk somewhere and you get it off their balance sheets, making more efficient use of the balance sheet that's available. And the other point that I would make, and this is quite an important sort of regulatory point, is there's one exception to my point, and I don't think regulatory relaxation is the answer, is that we do believe and have acted on the point that should central banks need to lend to private banks, it would be silly if that lending itself somehow worsened their regulatory metrics. So we have exempted in the UK some time ago central bank reserves from the leverage ratio. What that means is, as I say, that if you do lend to a bank, it doesn't increase leverage and require to borrow more cash and get a sort of horrible positive feedback loop. That was effective, we believe, during the crisis. And it's interesting that the US authorities, temporarily at this stage anyway, did the same thing last year, and also I think saw benefit from it. So I think we definitely need to look at intermediation capacity. We definitely need to be sensitive to it, but it's not an answer, I think, to problems over here, to revisit the possibility of creating problems over there.
Yeah, I got a question from some colleagues. One of my colleagues in the markets team asking on similar lines. Dara Rana Singh writes for Reuters on markets. She says the post-crisis regulation has hit banks' market-making ability. So what can be done to boost their role as liquidity providers in future crises? I don't know if that goes over the same ground that you were just talking about.
I think it goes over similar ground. I mean, it's interesting. I years ago, decades ago, in fact, I had a role at the Bank of England when we were still responsible for the gilt market, of kind of supervising the gilt edge market makers. And at that time, there were 15 or 20 of them, and most people said, "Wow, that's too many. Surely that number's going to fall because no one's making any money, and it's terribly challenging to do this business." 10, 20 years on, the number of gilt edge market makers in gilts is much the same. It's difficult to be a full function bank or broker dealer if you can't offer services in the risk-free asset or the near risk-free asset of government bonds. So I think the expectation of the imminent death of the broker dealer has been sort of foretold a couple of times and hasn't come yet. But I think it largely does go over the same ground. Otherwise, Bill, I think it's something we need to keep very close to. We speak to these people every day. They are obviously the people who sell the gilts to us in our APF operations, and vice versa, buying the gilts from the DMO and similarly overseas. And we understand and speak to them a great deal. But I don't think the answer is to turn the clock back and go back to a place where we solve one problem and create another.
Yeah. David Robinson at Market News International says, how do you get around the problem that if trigger points for bank asset purchases were known, market players would have incentives to drive prices to hit them?
Yeah, so I think this is a really great point, and I would distinguish what we're talking about here, a market maker last resort, from something like a yield curve control model or something which is obviously a monetary policy tool. The market maker last resort seeks to avoid targeting a particular price level. It's absolutely right. The question says that if you set yourself up to defend a particular level, you've got to be willing to do it in very, very large size in order to make it credible. Obviously, if you do make it credible, you don't actually have to buy anything at all, but we all know how that goes wrong as well as how it goes right. In market maker last resort, you're not defending a particular price, you're defending a particular spread. And what therefore you're saying is that if for any reason market functioning deteriorates to a point where spread, or another functioning metric, but let's call it spreads because then this is pretty easy to understand, blows out beyond a certain point, and that point will probably be quite wide, then you would say, well, actually at that point we would conclude that markets are not functioning very well. We would buy if prices have got too low, and we would sell if they have got too high relative to the market mid. So if the market mid moves up, as it doubtless would, your intervention prices move up with it. So it's a great point, and it's still a risk, by the way. It's obviously still a risk that if for some reason in a market spreads blow out a lot and you can't get functioning back, then central banks could find themselves buying a very great deal at one margin or the other. But the idea is knowledge that the central bank's going to intervene at some width of margin will bring them back narrowly again. And so long as we are positioned symmetrically around the price, we will switch over time from being the preferred seller to being the preferred buyer from. And that's why I put that slightly obscure chart perhaps of the corporate bond facility up, because that's exactly what happened in that respect. But sorry, long-winded answer, but just one final point. It is nonetheless true that the calibration of those intervention prices is very important to get right in order that you don't kind of act as a blank check for public sector money. But I think this protection of pricing a spread rather than pricing a level gets you some of the way there.
Yeah, talking of blank checks, I mean, a couple of questions have come in about moral hazards here, and I mean, just summarising, there's one from Ben Nelson. How should the central bank put be circumscribed ex ante to avoid kind of moral hazard as the effects of the pandemic fade? And is there a risk that the sort of sense of the central banks having the markets back set in already, despite obviously what you're trying to say today is that reform is coming, but is there a risk that the market already thinks that's there?
So I think to separate a few things here. So in terms of the monetary policy reaction, which is obviously overwhelmingly the most important part of this story at the moment, and continues to be given where the COVID data are going at the moment. I mean, the message that central banks want to send is we have adopted a heavily expansionary policy, and as the US, for example, has put it in terms of its average inflation target, we need to see quite a lot of evidence of inflationary pressure before we even start to raise interest rates again. So that, I mean, I wouldn't say it was a put, I'd say that was an explicit decision on the part of policy committees to be highly expansionary for a period whilst the economies hopefully recover. Separate that, though, from the question of these sorts of facilities and whether they could themselves create a moral hazard. I think it's precisely because there is a concern that that could happen that we are making these proposals. So the features of what we're talking about here that are designed explicitly to deal with the risk of moral hazard include the fact that it is a standing facility with known intervention criteria. We learned in the last crisis that relying on what was rather oddly called constructive ambiguity was a pretty bad idea, to be honest, because every bank thought they'd be saved. it turned out when it came to it that they weren't. They were badly underinsured, or hell broke loose. So actually, constructive ambiguity in banking didn't help. It's unlikely to help very much in terms of non-banks as they become more important too. That's one of the reasons why we think standing facilities of various kinds, where you know where central banks are going to intervene, and just as importantly, where they're not, that helps with that. The second thing is this so-called backdrop pricing, maybe a pompous term, but rather than an expectation that the central banks will intervene at the market mid-price, as we just discussed in response to another question, we'd be setting a spread around the market mid, and that would be widely known and understood in advance. And firms would say, well, I can't expect central banks to come in at the mid if it's pushed somewhere else. I need to take my own self-insurance steps. And then look, finally, and perhaps most importantly, this is why it goes alongside with the regulatory reform as well, because clearly firms need to think again about the sort of buffers that they have in place for future liquidity events. So I think there's no doubt that you get this wrong, you could end up, blowing up moral hazard or inflating it. But actually, this is not necessarily about more central banks. This is about better targeted central banks. And one of the key drivers of it is exactly the question that Ben asked you.
Absolutely. Well, we have about less than 15 minutes of our allotted hour to go. So I wondered if I could just ask you some other questions on other issues that I think touch upon the kind of things that you worry about at the bank. I mean, this is are we a week now past? I think we are just a week into our post-EU single market life, and that represented quite a big change on January the 1st. There's been quite a few stories written on the first day of trading on Monday of this week about share trading moving to other centres in Europe for clients, for listings that are based in the EU. Could you talk us through a little bit about how smooth or what kind of disruption you saw early in the week, not only in equities, but I think also there was some concern that the derivatives markets might be choppy around the time of the change.
So I think it's worth starting, and apologies for this, but it's worth starting by saying what my role is and is not. I mean, I'm not primarily responsible at the bank for the regulatory debates, negotiations, discussions, and some of the broader political debates are obviously for government. Our role, my team's role, is really threefold. It's firstly, ensuring our own operations could continue to work effectively. Given everything we've talked about, we're still doing a great deal in that respect. Secondly, it's ensuring that we had contingency plans in place if bad things did happen. And thirdly, it's closely monitoring markets, which is where your question probably goes. I mean, the positive answer to the question is that in terms of market functioning, which is the thing that matters most to my team in the bank, it's so far been very smooth, really very smooth. And I think there are two reasons for that. The first is there was a great deal of preparation for the possibility of a worse outcome. I mean, years of preparation, if we're being honest, and a lot of work by UK regulators and overseas regulators as well to put in place transitionary arrangements, and those arrangements, give or take, seem to have worked, at least in terms of smoothing that any potential cliff edge. Equally, the trade outcome was pretty close, I think, talking to market participants, to what people had expected. So, I mean, taking those two things together, we were watching, very, very closely indeed, including over the Christmas break. Market functioning has been very smooth, and so that element of it is good. I mean, I think it's obviously early days, and it's important to keep an eye on at least sort of two things. Again, I'm sticking on market functioning for now. On the downside, any emergence of any signs of substantial discontinuities in market activity or liquidity. We're not seeing that so far. That's not to say that nothing is going on, but there is nothing staring us in the face so far. On the upside, and we shouldn't lose sight of that point as well, there is a lot of debate, obviously, about whether, given that there were potentially quite large risk premia priced into UK markets relative to overseas, against the possibility of a bad transition, whether that might encourage some funds to return. We were doing quite an extended set of outreach discussions with US and Asian investors in the weeks leading up to Christmas, And there's certainly no doubt they were watching things, very closely. There's no sign of a tsunami of reinvestment flows yet, but the sterling corporate bond market, for example, has opened strongly this year, and I think there clearly is something there to watch quite closely. On the question of the future of the city, I mean, in a way, of course, the Bank of England, it's not the Bank of England's role to act as sort of cheerleader for particular parts of it, but I mean, it obviously is important that we have deep and liquid and well-functioning markets to transmit policy and indeed to provide for economic growth. So the UK starts as an international financial centre, arguably one of the top two or three, and a majority of the activity in the city comes from outside the EU. The basis for that is expertise, time zone, all the things we talk about a great deal. It's also a robust set of regulatory standards. And I think we've said, and I know the government and governor was saying this only yesterday, Treasury Select Committee, that's something we intend to push forward with and to ensure that the regime that's in place after Brexit is one that continues to act as a beacon for high standards. Yes, there have been stories about business moving. There have been some stories about jobs moving. So far, those numbers look like they're within the bounds of the sort of thing people have been talking about, but we are keeping a close eye on it.
Yeah, and now that we are outside of the EU, is there specific areas of regulation in the markets that you think that could be beneficial for the UK to take advantage of this new flexibility that it has?
Well, I mean, it's obviously true that the UK shaped the EU regulation regime in many ways. So I think it would be surprising if one started from day zero, with a massive wish list of things that one wanted to be, fundamentally different. It's not my area of expertise. Market regulation is obviously primarily in the UK for the FCA. I think, and to slightly abuse the question, the biggest issues, if I'm totally honest with you, are the sorts of things I was talking about in my remarks today, which are really global in nature. Whether you're in the EU or outside the EU, these questions about liquidity shocks in the non-bank sector affect all of us. The US, Japan, the Eurozone, and others. And it is striking, and perhaps the most important point from my perspective, that the communications that we have amongst me and my peers, amongst central banks, which were good throughout the crisis last year, I'm confident will remain very good going forward as well. So I slightly dodging the question, I realise, but I think some of the biggest issues are global rather than relating to the EU relationship.
Understood. Are there any signs of stress that are causing you any concern at the moment in markets?
Well, that's a different question, isn't it? And I think we are looking at that very closely. It is striking how optimistic the tone in financial markets is. It goes back to some of the questions I think that we were talking about earlier, whether you call it central bank put. I prefer not to use that term, but undoubtedly the huge impulse from monetary and fiscal policy that we've seen over the past 12 months or so has done no harm to the level of risky asset prices, as has the very, very low, persistently low yield curve as well. And so I guess, central banks are paid to worry. So on the one hand, that's great news. On the other hand, the question would obviously be, could you get to a point where risky asset prices have got ahead of the reality of the underlying economies and this sort of horse race between the vaccine and COVID, which seems to characterize a lot of analysis at the moment, starts going south. That's something everyone is watching, very closely, and I think it's possible that you could get an adjustment in that area. But so far, so good. Obviously, interest rates being at or near, I was going to say the zero nominal bound, this was not the right phrase, but whatever the lower nominal bound for interest rates is expected to be, creates a range of new and interesting questions. Geopolitical risk, we were telling ourselves that once we were away from the US election and Brexit, everything would be clearer. Well, I doubt that's true. I suspect we're going to replace one set of uncertainties with another. We haven't talked about climate risk. We haven't talked about LIBOR. I mean, the set of risks out there, some of them structural, some of them conjunctural, is long, to be honest, and sort of morphing into the question of what 2021 holds for me and my team. There's a lot to keep us busy, even if COVID were not around, which it obviously is.
Could you just explain a bit more about the LIBOR risks? Obviously, the bank has been very keen to stress that this is it. This is the end of the road for LIBOR. Even if I think in the US, if I understood correctly, it can go for a little bit longer. What is the risk around that?
Well, I mean, it's not just us keen to stress. I mean, the providers of LIBOR at the moment are consulting on the cessation of LIBOR in Swiss franc, in euro, in sterling, and in some tenors of dollars as well at the end of this year. And without wishing to front run that consultation, I'd be surprised if the result was, well, no, thanks very much. As you say, the more heavily traded tenors of dollars, are expected to continue for a bit longer, to the middle of 2023. And that is largely to deal with the so-called endgame, the legacy. And the reason for that is because there are, particularly large dollar-based exposures in the global economy. The important point is that we in the UK and the US regulators as well have said that all new business based on LIBOR should cease this year. In sterling, it has to, because sterling LIBOR will not continue beyond the S of this year, and that's the bit of it that I'm primarily responsible for. And by the way, there isn't really disagreement between the authorities and the market on that point. Most of the work is led by the market, and frankly, Tushar Mazaria, who's the CFO of Barclays, leading that work in sterling. Frankly, they just want to get on with it now. LIBOR is not something you'd want to be part of. I mean, as I said in the speech last year, during the height of the dash for cash, LIBOR, which is the beating heart of the global, fixed income business, was based on 0 transactions. And that is a highly risky thing to want to be part of. So I would question anyone who said, oh, great, I've got another year and a half, to remain exposed to LIBOR. Actually, those people should be worried more than the people who are getting out of it.
Understood. We're down to the last couple of minutes. So just one other big one that's out there. And I know you're not a member of the Monetary Policy Committee, but there is a live discussion about the feasibility of taking bank rate negative. I don't know if you can give us any sense of when that report is likely to be published. But perhaps more personally to you, what would negative rates mean for you and your team? I mean, what changes in a negative would change were there to be the possibility of negative rates?
Well, I thought you were going to answer, Bill. Can you just tell us when rates are going negative in the UK? And I'm sure that would probably make it a mistake. But luckily, I have no idea is the true answer to that. I mean, as you say, there is a very live debate amongst policymakers about the pros and cons, indeed the case for even doing it or not. And you can read about that in the Monetary Policy Committee minutes, and I'm sure that will continue for some time. My job and our team's job is solely to monitor the market discussion of this, actually, because it is important to understand where the yield curve is going and people's expectations about that. And it takes up quite a bit of our time in discussions with market participants. I can tell you, it probably doesn't surprise you. In terms of our operational responsibility, it's solely to be ready to do whatever it is that the MPC asks us to do. There are 2 stages really to the feasibility, the practical feasibility work that I described. One, and the much more publicly visible part, is this so-called Dear CEO process that began last October, where the bank has written to all of the commercial banks to say, look, what will it take? How much will it cost? How long will it take for you to get ready to be able to implement negative rates if you chose to do so? The returns on that are in. I think Sam Woods, the head of Prudential Supervision at the Bank of England, said yesterday at TSC that he expected the Bank of England would say more on that work in the February monetary policy report. So I think that date is out there. In terms of what it means for us, it's rather different to that. It's being able to implement negative rates, and there's kind of 3 points to that. One is getting the plumbing right. One is about thinking about some quite complicated technical issues to do with something called tiering. So are there different ways of setting negative interest rates that can affect the NIMs of banks? We can talk for hours about this. I know we haven't got the time, but there's sort of technical policy issues around that. And then thirdly, and actually not least, which is a little bit like commercial banks, you have to go searching for all the IT systems in your institution that might go a bit haywire when rates go negative. Whether it might be a financing system or bizarrely even things like your canteen or something, I don't know. So you do have to go looking for that. So there are 2 or 3 sets of practical issues. This work will all take some time, and so it is ongoing rather than resolved. I think, candidly, I think it will be the ability of banks to be ready for this that will be the rate determining step, but an awful lot of work left to do in that area.
Yeah. Andrew, it's bang on 3 o'clock.
There we go.
Thank you so much for your speech and for taking so many questions. Really appreciate it. Best of luck with the reform push for the non-banks, and I hope we can speak again soon.
Great. Thank you very much, and thanks to Reuters.
Thank you very much.